Now we're going to move on. We're going to look at three key assumptions that technical analysts make as they do their analysis. We'll look at each one of these assumptions individually. These are all extremely important as well. The first one is something that we see at StockCharts people getting wrong a lot. And it's very dangerous if you get this wrong. Liquidity is super important in order to perform technical analysis. Liquidity means that the stock has high volume of trades, that no one group or individual can manipulate the price or cause the price to change in and of themselves. If you go back to our definition of a market, another way to say this is that we want the market to be really large. We want the number of people involved in a stock to be extremely large because, again, at its core, we're trying to understand their mass psychology. To understand the mass psychology of one individual, well, that you can't talk to, kind of hard. It's finding large numbers of greed and fear, elements of large amounts of greed and fear in that market and understanding how that interacts. Those are the core concepts of technical analysis. Lots of volume doesn't necessarily mean lots of liquidity either. There can be a couple of traps here. You can get some large volumes on some very, very low price stocks, sub-penny stocks. That still could be fooling you, though. It doesn't necessarily mean those stocks are liquid. The lower the price, the more danger that your stock is not liquid. Things like Amazon, Microsoft, the big boys, and even mid-caps, those are going to be fine. It's when you get smaller and smaller that you start to run into problems here. Second assumption that technical analysts make is that there's no artificial price changes. By artificial price changes, we mean changes that are created by entity other than the market. So what entity can change a price other than the market? It turns out the company can. The company can declare a split, can declare a dividend or a distribution. Those kinds of things will have an immediate effect on the price, typically cause a gap to appear on the chart, like you see here. Now, if you are just looking at that chart and you do not realize that there was a split involved, you would look at that chart and you would say, yikes, something bad happened there to cause that gap. The market suddenly changed its opinion about the stock and everything went down. Well, again, fortunately, it was just a split. And so what we can do is we being the technical data providers, can factor the effect of the split out of the data and essentially eliminate that gap. In the case of a 2-for-1 split, what we do is we would take all of the, here we go. To remove a 2-for-1 split, you must divide all the historic prices by 2 and multiply all the historical volume by 2. Because that's essentially what happens during a stock split. If you had 100 shares before the split, after the split, you'll have 200 shares priced at half of what they used to be priced. So we just reverse that math in order to get rid of the gap on the historic data. Now there are two little traps here, and we'll talk more about this with our StockCharts presentations tomorrow and the next day. But just so you know, one of the tricks here is that when you're doing technical analysis, you are not interested in preserving an accurate record of trading in the past. You're interested in getting rid of these gaps. That's going to distort where stocks actually traded at in the past. But it's going to make sure that the technical analysis that you do is accurate and focused on mass psychology. So, the final assumption that technical analysts make as they do their work is that there's no extreme news. Unfortunately, we're getting extremely close to the anniversary of probably one of the big whoppers of extreme news. 9/11 certainly had a huge impact on the markets. There's absolutely nothing in technical analysis that said 9/11 was coming or would happen. When extreme events like that happen, and even to a smaller scale, let's say the CEO of a company is hit by a bus or I don't know, some other major tragedy befalls a company. Those kinds of things are not predictable. Technical analysis is not clairvoyant. And sometimes you just have to wait for prices to settle down, for the market to get its psychological mind collectively back together before technical analysis can begin to help you again.